All right, let's dive right in. We're going to break down a really compelling argument that the silver market is under a kind of stress we haven't seen before. The core idea: the way silver has been priced for decades might be on the verge of a massive, massive change.
So let me just start by asking a question, a pretty provocative one. What if that silver price you see on the screen every single day, the one we've all taken for granted, just wasn't the real price anymore? What if it just vanished?
And that question, really, it gets to the absolute heart of what we're talking about today. The claim is that the paper silver market, the system that's been setting prices for 50 years, is showing some serious cracks.
Now, when I say paper silver, what I'm talking about are things like futures contracts, ETFs, basically financial promises for silver, not the actual physical metal you can hold in your hand. And the argument here is that this isn't just a theory anymore. It's based on real observable signals that suggest the whole system is under extreme pressure. And maybe, just maybe, the window to act is closing way faster than anyone thinks. So, what are these signals?
Well, according to this analysis, there are 3 really distinct warning signs that are flashing bright red right now. Let's walk through each one. So the first sign is this really strange pattern that happens almost every single day in global trading. During Asian market hours, the price of silver tends to climb, driven by what seems to be real physical demand. But then, and it's almost like clockwork, the moment the New York market opens, bam, the price gets slammed down by a huge wave of paper selling. It's a daily tug of war.
In this battle between East and West, it's being presented as major evidence that physical demand is just getting too strong to be held down by these paper contracts anymore. The analogy they use is a spring being pushed down and compressed to its absolute limit. And you know what happens when you let go of a spring like that? Okay, warning sign number 2 is way more direct. It involves a legal term you might have heard of: force majeure. It's basically the get-out-of-jail-free card for contracts. And the claim is that the London market, one of the biggest precious metals hubs in the world, actually had to use it. In plain English, that's them saying, we sold you silver, but sorry, we can't actually deliver it. That's a huge deal. And you can see just how severe that failure was right here. To handle the shortage, the cost to just borrow physical silver, they call it the lease rate, it just went vertical. I mean, it's skyrocketed from a totally normal 1 or 2% to an absolutely unbelievable 80 to 100%. That's not just an anomaly, that's a 5-alarm fire signaling a massive physical squeeze. Now for the third signal. And this gets right to the core of the whole paper system problem. This number, 200 to 1. What is that? Well, that's the alleged ratio of paper claims on silver to the actual physical ounces that are available for delivery. Think about that. For every single ounce of real silver in the vault, there are supposedly 200 paper IOUs floating around out there. And as you can imagine, an imbalance like that puts incredible stress on the big exchanges, like the COMEX. Just look at this. The percentage of contracts that were supposed to be delivered as physical metal but were instead forcibly paid out in cash, well, that number nearly doubled in just 1 year. We're talking about almost a quarter of investors who said, I want the metal, being told, sorry, can't do it, here's some cash instead. And look, these aren't just fringe ideas from the corners of the internet. This viewpoint is backed up by a pretty stark warning from a former precious metals bank executive named Barry. His words were that the entire global delivery system is under, quote, significant tension. So, okay, we've seen the warning signs, but what would a full-blown breakdown actually look like? What would it feel like? Well, the argument is we don't have to guess. We already got a little preview back in 2020. That was the real-world stress test. This is probably the most important point of the whole argument. Back in 2020, the paper price you saw on your computer screen crashed. I mean, it plunged to as low as $12 an ounce. But if you actually tried to buy a physical silver coin, the price was closer to $27 an ounce. And that's if you could even find one. Dealers were sold out everywhere. The paper price became totally irrelevant. So, this all leads to the big central question. 2020 was a temporary shock, right? The system bent, but it didn't completely break. It stabilized. But what happens during the next crisis if this time it can't recover? Okay, so if you find that whole backdrop compelling, the source material doesn't just leave you hanging. It proposes a really clear 3-step action plan. It's pretty straightforward. First, stop trying to time the market for a slightly better price. The idea is that worrying about a few dollars here or there is completely missing the forest for the trees. Second,
prioritize having the physical metal in your hand over any kind of paper promise. And third, get your position in place before the general public finally wakes up and realizes what might be happening.
And this slide really breaks down the logic behind that urgency. It's all about what they call asymmetric risk. I mean, look at it. The risk of being a few years early is that, yeah, your capital is tied up for a bit, but the risk of being just one day late, you could miss the entire opportunity. Forever. You're left holding cash while the physical supply just evaporates.
So what's the actual recommendation? We're talking about a portfolio allocation of somewhere between 5 and 20% in physical silver. And the analysis is crystal clear on this point. You do this with no debt and no leverage. This is presented as a wealth protection strategy, a life raft, not a speculative get-rich-quick gamble.
All right, so to wrap this all up, let's look at the key things they suggest you can actually monitor yourself to track the stress that's building in the system.
There are three main things to keep an eye on. First, the inventory levels at the COMEX exchange. Are they still dropping fast? Second, that percentage of forced cash settlements. Is that number still ticking up? And third, those silver lease rates we talked about. Are they staying weirdly high, way above that normal 1 to 2%? The catch, of course, is that by the time these things are making front-page news, it's probably already too late to do anything about it.
And that brings us to the final thought from our source, which I think just perfectly sums up the entire argument. When you're dealing with a potential historic shift in the market, the claim is, it's far, far better to be 10 years early than even one single day too late. Thanks for joining this explainer.